Hello, Gary. Good to have you back. I'll dive right into it. How are we looking this week?
Well, it's all about the Fed this week, Nivan, and there's huge expectations that we're going to see a 25 basis point rate cut. I think if you go back maybe a matter of days, there was some hopes for 50, but two factors that go into that decision. One is the state of the labor market, and secondly, the state of inflation. On the chart, on the picture I've got in front of us, um, you've got two lines. One is the lighter line, which is the inflation data over the last couple of years. And you can see that we've been tracking up since April. That white line was reported last week at 2.9. It's always sobering to think that the Fed actually wants to be at 2. So 2.9 is a long way away from 2 to suggest that there's a kind of a desperate urge to cut interest rates. But that urge to cut interest rate has been coming from the labor market, which I'll just reflect on in a second. But what was striking to me is that there was another data point last week, which is the yellow line. And this shows the household's average expectation of inflation over the course of the next 5 years. And you can see it's at 3.5%. Now, if you go back in time, if I was to show you this over 20 or 30 years, typically the household sector is at somewhere around 2.5. So 3.5 is a big deal. And part of that, of course, has been conditioned by the high inflation expectations we had around tariffs when all those announcements were made back in April. So if I looked at the inflation rates alone, there isn't a pressing need for the Fed to cut interest rates. But to be fair, the labour market data has been softening of late. There was a lot of talk about this big revision to the data, which saw 800,000 people come out of one of the numbers. But all that's happened there is that the number of people in work who are insured has gone down, but we believe the uninsured, so typically people who are migrants or work for themselves, they have increased. So it's not that there's mass unemployment around the United States, far from it. But when you aggregate it all up, I think we're looking at 25 basis points. We'll be looking at the statement to see what they say about future rate cuts. And I think Jay Powell will probably be careful about what he says. He won't want to overcommit.
Are we still on track for a 75 bip cut till the end of the year?
I think that's consensus. I would err on the side of caution and say maybe 50 basis points. I mean, to go back to the inflation data, we only got most of those tariff increases. They only took effect from the 1st of August. And if you go back to the time when Trump introduced his tariffs in his first presidency, it took 6 months for those tariff increases to work through to headline inflation. And every month for 6 months, the inflation data went higher, not lower. So given we're starting in a sense at 2.9, we are all likelihood be at 3.5. So tough for the Fed to be cutting interest rates aggressively unless there's a holding out of the labor market.
And any other thoughts on commodities and the debt market?
Yeah, and the debt market has, I think, performed too strongly. We've seen the 30-year yield drop by about 60 basis points, which just doesn't seem right. We will in the next few weeks have a battle in Congress over whether the government gets closed down because they'll need to have a consensus around an agreement of increasing the debt limits. And obviously, with all that's happened in recent weeks, they're really not getting on in Congress. And it's quite possible that those negotiations will go through some of the deadlines and government will get closed down. So, there's a huge contrast, quite frankly, between a gold price that every week we keep talking about new highs. The 30-year in the past was tracking that, but at the moment has kind of gone its own way. I think there'll be some reversal. So my recommendation is buy the gold and just be careful on bonds at the moment.
There was also a lot of information over the past week about a potential US-India trade deal, a lot mainly from Twitter, given the relatively new warm comments from both Trump and Modi. So, any thoughts on how that could pan out?
I think I'd be hopeful, but I think I'm hearing that Modi will also have another plan. And that plan will say, listen, if we can't do business with the United States, let's go and get partnerships which have maybe a greater concentration of trade than we've seen before happening. So I wouldn't be surprised if Modi, in tandem with trying to placate what's going on in the US, is also doing deals with Europe in particular to expand the breadth of trade that goes on between those two nations. After all, Europe's bigger in many senses than the United States, certainly in terms of number of people, but also I think at this point in terms of bonhomie, getting on. And I think Modi may pivot that way as a backup plan to not getting something agreed with Trump. But I hope, because at the end of the day, I think Trump made a point with his huge increase in tariffs. But as he's done with other nations, he then tends to backtrack. So let's hope that's the case this week.
Also, with respect to China, despite the equity markets performing admirably this year, there has been signs of weak retail and weak housing, especially over the last week. How do you think that will sort of move towards the tariff talks between China and the US? Because that seems to be faltering, especially based on what Trump has been saying lately.
It does. I mean, I think Trump would take a misstep if he felt that that data was going to make the negotiating position of China that much more weaker. But remember, at the end of the day, China can do things within its country. It's got a huge population. It's got huge scope to tidy up still things in its debt markets, particularly that related to real estate. And they have this kind of once in 5 years big Congress coming up with the Communist Party, where we're expecting further both tactical and structural changes and the evolution of policy to happen. And all these things are coming in the fourth quarter of this year. So I suspect that the weak data that we've seen this morning will pressure the Chinese to push on with some of those reforms. And they'll have one eye on what the negotiations with the United States is going on. But at the end of the day, it's for the Chinese, in a sense, to stimulate their economy in their own way and not have to rely on doing trade with the United States.
Great. And lastly, with respect to Europe, unlike the US, which is looking to reduce rates, the ECB held rates steady. How does that sort of indicate growth expectations from the European markets?
Yeah, I don't think you can expect too much. Thankfully, the European markets have, got global sales, not just dominated by the domestic market. I think the ECB is being circumspect about cutting rates further, principally because they don't want to rush towards zero and then have no policy flexibility. So they want to be measured in the way in which they spend these rate cuts. And therefore, I think it'll be the back end of this year before we get the next rate change. And in the interim, they'll be hoping, particularly the government spending increases we're seeing in Germany, that they're very supportive. The other thing to point out is it is a bit of a bifurcated market at the moment. France, with all of its problems, its credit downgrade that we saw over the weekend will do a little bit of damage to the bond market. But if you look in the southern Europe, they're doing well. I mean, Spain at the moment is looking like an emerging country in terms of its growth rate. So it's not all bad news. But as I said, I'm not so sure monetary policy is going to be so supportive. It will wait until the end of the year before it gives another boost.
Lovely. I think that perfectly manages our 10-minute mark. So thank you, Gary,
Thank you.
and hope to see you next week.
Thanks very much.
Cheers. Bye.